All right. Well, welcome to part 4 of this 10K tutorial. This one's going to cover both the balance sheet and the cash flow statement. So I'm going to show you how to work through those and also be able to pick up some simple valuations that you can get from those two statements. So the price to book's an obvious one, and the price to cash is maybe a less obvious one, but one that definitely needs a lot of discussion. So gonna run through those and hopefully help you. If you're good with the income statement, that's good. Check out the old videos as far as part 1, 2, and 3 of this 10K tutorial series. And if you're really looking for more stuff on the balance sheet and the cash flow statement, we'll definitely cover that one in this tutorial, this part, and also part 5. So to start out, I want to take like a kind of like a asset heavy type company. So a company like Walmart. And if you don't know how to navigate through the sec.gov website, check out part 1 of this tutorial series where I walk through that part. So we're going to go ahead and check out. Let's do the price to book first. So basically we want to see what the assets picture looks like. Assets are obviously very important because assets create profits. Assets create revenues, revenues turn into profits, and so a great way to increase revenues and profits is to increase your assets. You want to make sure assets are going in the right direction, and you want to make sure that whatever you're paying for in the market, that you're getting enough assets back. It's just a good general margin of safety rule to get low metrics such as the price to book ratio to be where you want it to be. So I don't know, let's just say, we'll look at 2018 and 2017 since that's what's on this income statement or this financial report. And I'm going to do something different too. I'm going to make like a Google Drive and I'll go ahead and like upload every spreadsheet I use in these tutorials, any YouTube tutorial, and I'll make that available for people who sign up to the free email list. So that's stockmarketpdf.com. If you want to learn more about what I'm about, that's einvestingforbeginners.com, and there's also a way to get on the email list from there. But let's look at a few key things. So to me, when we're looking at the balance sheet, these are going to be the things that stand out. So, here's the balance sheet, right? We have assets, and so assets is split up into current assets, which this is how you determine a company's liquidity. So you have cash and cash receivables. That should be obvious. This is what their cash balance is. Receivables is money that's going to be coming in. Inventories is the value of what inventory they have, and prepaid expenses and other. Kind of similar to receivables. And, outside of the current assets, you have kind of like the longer term assets, ones that you can't really liquidate quickly, right? Like big property and equipment, you wouldn't be able to liquidate that tomorrow to settle a big bill that came in for the business, but it is still definitely an asset and it's still a major part of the company. So you have like property and equipment, and that gets depreciated down, which one of these days I could do a YouTube video about depreciation and all that. So you got to make sure that's all in there. You have stuff to do with properties and leases and finances, so they kind of sort all that out too, but you still want to represent it in the balance sheet and make sure that's put in there. And then this right here is goodwill. So what that means, it's basically assets that's not intangible. So it's any sort of intangible asset, meaning anything that actually does create a profit, but you can't sell it in the marketplace. So, for example, like Walmart, the kind of brand name of Walmart, I guess you could say, people might drive by if they're new to a town and they want to buy something and they don't know where they could get it. The name Walmart kind of pops out right away. And so they might drive there rather than some other place. And so that obvious brand name of Walmart has value. So it's not clear how accountants calculate goodwill. And I'm sure it's going to be different per each company. They usually do a good job in the annual report of kind of talking about where the calculation came from. So like here, you can kind of see they break it down a little bit more. Basically, if the company was to be bought out, what would be the fair purchase price? Basically, the excess of that would be goodwill, which is, why is it being bought at more than total assets? And that's going to be what your goodwill represents. And so that kind of basically covers all of the balance sheet. Let's go back to it. As far as the assets part of the balance sheet. So that makes up total assets. Now you have liabilities. The same as the current assets, you have current liabilities. Short-term borrowing. So this is all stuff that's like due soon, right? Or stuff that they're going to need to keep cash on hand in order to take care of. So short-term borrowing, that should be pretty obvious. Accounts payable. This is just like receivables, but the opposite, right? Where if I'm a store and I'm needing to buy carts from the cart business, I might put in an order for 100 carts and expect to get that next week. So that would be like under accounts payable is as soon as I put that order in, right? Accrued liabilities, accrued income taxes. That's a little less clear. The word accrued kind of gives you the idea that this stuff's being carried over from before. So something I like to do whenever I run into something that I don't necessarily understand, and apparently I don't know how to spell accrued. There we go. Is I like to search it. And so what that does is it gives me more explanation on what that means within the 10K annual report. And a lot of times that can help me understand what's going on. Okay, so here we go. There's accrued liabilities. And what they mean is this is in reference to how they're paying their workers, right? And so you can see, as for example, a worker might accrue vacation or bonuses, then that's where that's going to come in. So cool. I mean, that's, I think, a good example of how not everything in a balance sheet or an annual annual report, how it's not always 100% clear. And even if you're a quote unquote so-called expert, there can be a lot of variation in there. And so instead of just give up when you don't know something, try to do a little bit of investigative research. So if I can show you how to do that and empower you with that skill, then I think you'll be able to understand 10Ks a lot better. So you can see we were able to solve that really well. Long-term debt due within 1 year, that's self-explanatory. And capital lease and financing obligations due within 1 year. Again, that has to do with the property and lease obligations, expenses, all that stuff. So all that stuff, like accrued income taxes, that's going to be from profits, right? Accrued liabilities, that's going to be from the workers. Sounds like all that stuff either needs to be paid right away or could possibly need to be paid tomorrow. Or, if it's considered being needed to be paid within a year, then all that stuff's going to count as current liabilities. So I'll show you a quick kind of fun metric um, that compares current assets and current liabilities. And so basically the idea of this metric is to give you a sense of a company's liquidity. And so what that means for a business like Walmart, let me, before spoiling the surprise for you, let's do it ourselves. So we're going to go current assets, current liabilities, and I'm going to tell you that's called the current ratio. Ta-da. So basically the current ratio is going to calculate itself by taking this, dividing it by this. And so the higher the ratio is, the more liquidity a business has. And when we say liquidity, that means like short-term liquidity. A company could definitely have great liquidity in the short term and be so heavily leveraged that it could still be high risk. But this is one of those cases where it shows basically like a business not needing to necessarily take on a bunch of quick debt or really bad interest rate loans to pay off these kinds of expenses that might pop up right away. So while it might not give us the overall picture health of a business, it is a good kind of peace of mind metric. And you obviously don't want to ever see it too low. So we're seeing current ratios of 0.75 and 0.86, which isn't that great. And you can see it actually went down. So if we look at our trusty FinViz website and we look at their current ratio, you can see they calculated at 0.8. So they must be sourcing this from the 10Q. And I'll talk about that might as well talk about that since we're on the discussion of it. The 10Q is going to be the quarterly report that companies file. The 10K is the annual report. The 10Q is a quarterly. So the problem with the 10Q, and the reason why I don't like to use it, is because it is not audited. Audited, however you say that word. So, there could be discrepancies, and even in the case where there isn't discrepancies, yeah, sure, you might be getting like a more recent picture of what's going on in the business, but personally, I prefer to keep everything official, and I'd rather hear the official numbers that I know are 100%, basically 100% guaranteed. I mean, there can be amendments and stuff, but it's definitely more official than the 10Q would be, and gives you kind of like a longer time period as far as okay, so this is interesting. That is actually the latest, is this data here. So I'm wondering why there's a difference between how we calculated current ratio and how FinViz did it, because somebody's wrong. Okay. Could it be because I can't type? That could be a possibility. If only I were doing a live stream, then you guys could tell me right away, hey, you screwed up. 59664 and 78521. Okay, well, I don't know why. They could be rounding this too, right? Because if we round this, that's probably what it is. Okay, I love figuring stuff out. There we go. It's just they rounded it to the first decimal point, so that's going to be why it shows differently. So that's the current ratio. That's actually not a good current ratio. You generally want to see it at least above a 1. And, companies can have it at 2, 3, 4, which is very, very healthy levels of liquidity and current ratio. I'll kind of show you just as a real quick thing, if we take something like the S&P 500 and we look at current ratio and just kind of show you Okay, I don't know where it is. But let's just say how many of them are like above a 1, right? You go from 500 to 300. So more than half of them have at least a 1 in current ratio. Here it is. So you can see, look at Facebook has just a ton of cash. I mean, that could be cash. Again, it could be like inventory receivable. For Facebook, they don't really have inventory, right? So that's probably just a lot of cash and not that many short-term borrowing or, debt obligations coming up. In fact, that'd be kind of interesting. Let's just look at that real quick, and then we'll move on. But this is kind of interesting stuff, right? So this is another thing you can do. You can use interactive data instead of digging through the 10K. I don't like to do this as a generality as far as like if there's one way to do it versus another. But this can help you if you're just doing like a quick thing like we're doing with Facebook. So okay, so yeah, they actually have a lot of marketable securities. That's interesting. That's like marketable securities. That's like a Warren Buffett thing where his business, Berkshire Hathaway, they buy stocks in other companies, and that's how they invest their float, and it raises their assets. And as those stocks grow in price, then it makes Berkshire's shares grow in price because their balance sheet gets stronger because their asset prices go higher. And you can see, wow, Facebook has a lot of cash, a lot of marketable securities. And as far as like current liabilities, yeah, like I kind of predicted, right? The biggest one would probably be in relation to like what they pay their workers. So that's what this accrued expenses is. Accounts payable, partners payable doesn't have a whole lot. So that's an interesting, I've never known that about Facebook before. But anyway, back to Walmart. So that again, that's how you do current liabilities, and then you'll calculate the current ratio from that. And then just like you have kind of more longer term assets, you have long-term debt. This is like if they give out like a 10-year bond, right, where they want a ton of cash up front, they might issue a 10-year bond. They have to pay interest on it, but they get this huge chunk of cash and they just make payments over time. Capital lease and financing, just like the property stuff, deferred income taxes. And then you start to get to the equity portion. And so this is probably the most complicated part of a balance sheet. Basically, the way you calculate shareholders equity, or what they call here total equity, and again, it's going to be different depending on what balance sheet it is, what company you're talking about, how they want to word it. But in general, something like a total assets minus total liabilities is going to give you your shareholders equity. And so what they do in balance sheets to balance everything out, no pun intended, is they'll take total assets, and you always see total liabilities and equity equal to that same total assets number. And that's because the equation when you relate assets, liabilities, and equity is assets minus liabilities equals equity, or liabilities plus equity equals assets, which is like that total liabilities and equity, right? So you basically have this on one side minus this equals that. So if this is on the left side, you can add it to both sides, right? Like simple addition, and now you have liabilities plus equity. So what's cool is if we make like our own Excel spreadsheet, we can do that calculation for us by just typing in total assets and total liabilities, and then we don't have to decode like the shareholders equity stuff. Actually, and this is actually what I do in the value chart indicator spreadsheet, is I actually do it like this. So a lot of times companies won't put total assets in a column like they do total they won't put total liabilities in a column like they do total assets, in a row, not a column. So what you'll have to do is you'll have to find where that shareholders equity number is and then subtract it from the total assets to get your total liabilities. So in this case, we'll take like one of these, right? The total assets for 2018. And then to calculate, what's everything as far as the liabilities go, then you take the equity. And so what I noticed, even though the naming's different, they're pretty much almost always going to have that shareholders equity like right next to the total liabilities and equity line. So, you can see they did it right here. So you don't even have to look up here. You can just look, okay, here's total assets. Okay, here's the equity, shareholders equity. Boom, we're done. And so you can do the same thing for 2017. And, I actually originally planned to talk about cash, like I said in the beginning of this video, but I'm going to do a little pivot. So we're just going to focus on the balance sheet today, and I will change the title of the YouTube video to reflect that. But while we're in here, we'll talk all about cash next week. While we're in here, let's talk all about balance sheet. So there is a couple of key, just like we calculated the current ratio, there's a couple of key metrics we can calculate from these balance sheet numbers that will help us determine what the risk factor of a particular business is. So one that I love to use is the debt to equity ratio. And this is going to help you figure out basically the total risk. There's several ways to calculate debt to equity, and it depends on who you're talking to. Depends on the financial website. Sometimes they'll look at things like long-term debt, so they'd take this number, and then they would use that to calculate a sort of debt to equity number. So let's do it just like FinViz would. Okay, so FinViz, here's a perfect example of somebody who does it differently from how I would like to do it. So the way I like to do it is debt to equity using total assets, total liabilities, and shareholders equity. Basically, the equation for that is debt. And when I say debt, I want to know everything that the company owes, all of their liabilities. So I don't care about just picking and choosing little pieces because, even though like accrued liabilities, even though that's not considered a debt, it's still something you have to pay. Remember, that's them paying out to their workers for vacation. So even though it's not debt as far as how you would characterize it from a wording standpoint, it's still definitely something that a company needs to reflect, right? It's still an expense, so why not consider everything that a company has about it? So you just take the debt and you divide the shareholders equity, and it gives you debt to equity. So you can see for this Walmart, it's not terrible. Looks like it increased though, right? So it went from 1.47 to 1.53. That's not what we want to see. But it's not like, under 2 is decent. Under 1's good. Under 2's questionable whether you want to call that good or not, but definitely anything over 2 and you start to talk about real bad places for business to be. So let's calculate the FinViz debt to equity and the FinViz long-term debt equity. just because I'm going to be a stickler, I like to keep things small. I don't know why. It just looks nicer to me. Okay. So you can see the way they calculate it. They call it total debt to equity. But what we're going to do, slide this stuff down. So they're going to do like a long-term thing, right? So we're going to look here, and that's probably how they'll calculate that. So that would be 30,045, 36,015. So they're probably, I used total liabilities, remember? So FinViz probably wanted just long term. And if we compare to what FinViz said, are we going to be close to what they said? Make sure we're looking at Walmart, not. Okay, that's off again. I really don't know why. They're reporting earnings May 17th, so they can't be going off that newest 10Q. And according to Walmart, they do a 10Q every June, August, and December. So they should not have a new 10Q until June. So I'm interested to know how they came up with that. Okay. As far as debt, how would we do like a debt thing? If we were to look at strictly, and I don't know why the word's escaping me right now, but like a pedantic, I guess that would be the right way to say it. From a strictly pedantic view of the word debt, how would we pull that from the balance sheet? Let's call it FinViz debt. I would probably take long-term debt for sure. Obligations and income taxes does not count because it's not quote-unquote debt. Here, short-term borrowings, that's going to be debt. And then long-term debt within a year, that's going to be debt. So that's three little places. So here, 52.57. Here, 37.38. And here, the long-term debt. And we'll just take it from here. And I did it completely in the wrong spot. Okay. And then this one would be the same thing. So short-term borrowings, 1099. Long-term debt, 2256. And take the long-term debt again. Okay. And I'm just going to take like a wild guess that this is going to be completely wrong. Actually, I'm thinking I have an idea of why this is what it is. I'll show you in a second. The problem with using lots of different like I like to use Google Sheets and I like to use Microsoft Excel, but I also like to use Microsoft Excel Mobile, like on the tablet. Problem with that is you're always getting weird. It's always hard to find where stuff is because I'm never on the same program. I bet they're looking at just Walmart Shareholders Equity without the non-controlling interest. So let's look at that. It's still not. It's still wrong. Okay, it's frustrating. I will figure that out and get back to you guys on the comments. But basically, I was thinking, well, maybe they're looking at this because they're not taking consideration non-controlling interests, which I guess depending on how you want to look at it. I mean, so they're looking at per share at 26.34. Again, this is where the annual report can start to become frustrating because there's so many different ways you can define stuff. So it's kind of a big reason why these tutorials are long, but I'm hoping at least, we can kind of all together, if you have any comments, feel free to share, but maybe all together we can start to figure out what this stuff means. And get, more accurate pictures of what's actually going on. So, like if we did shares, because again, that's not working. So if you take their book value per share and you multiply it by the shares outstanding, that'd be 3010. So that would be a shareholders equity of 79 billion, which does not correlate to either of these. If anything, it's closer to this shareholders equity rather than what they say is attributable to shareholders. And I guess, how do you want to define that? Walmart as a business, even if there's an interest that's not, like the way I'm interpreting this, and I'm sure it's going to show up in like insider ownership. Basically, the way I interpret it is that there's some of the stock that's not all common stock or all available to the public kind of a deal. So that's what's going to attribute for the rest of this 2953. But, why just ignore it just because we can't buy it in the stock market, just because we can't buy it through the exchange doesn't mean it's not part of the business. I mean, it wouldn't make sense to me to just exclude it and calculate it as its own shareholders equity, and you just ignore, you would calculate it like this, ignoring that. It just doesn't make sense to me. You want to, if it's an asset, if there's assets and liabilities that are shared, and that's all part of the business, no matter if you're a common stock shareholder or you are somebody who has like a small interest in the stock, and that's a non-controlling interest, meaning you have like a small position that's not obviously doesn't have voting control or anything like that, then obviously it's still giving you the big picture of the business. Like, you shouldn't ignore that. So that's why I say, I always use this one. So that's a long roundabout way to say use the one that's going to be right above this one, and don't let the little footnotes kind of change that viewpoint. But anyway, and I'm assuming this isn't going to work either. So I don't know. I really don't know what FinViz is doing. Let's not get too worried about them, I guess. For all we know, it could be completely different for another company. I wouldn't put it past them to get something wrong. They have definitely done that in the past, and that's why I always double check, and that's why learning how to read the 10K is so important, because I had a stock, and it was recent too, in one of the e-letters. It was something that showed up on FinViz as a different, no, I was actually ADVFN. but I have seen discrepancies on FinViz too. But yeah, ADVFN showed the wrong number for like a net cash thing, and so it kind of threw off my value trap indicator calculation. And so it was one of those learning experiences where it's like, okay, I really need to make sure I'm always sourcing the 10K. So, showed you really important metric to learn how to calculate. It's going to be the debt to equity. That's going to give you risk, right? And one other one, and this is going to be a balance sheet valuation one, is we want to learn the price to book. So to get that, book value is the same as shareholders equity, by the way. I'll just note that because, like I said, I'm going to make a folder for this in a Google Drive. And so people will be able to reference that. And so if we have like these notes, then it will kind of trigger you guys in your memory to be like, oh, I remember that this is what this means. Just in case you're absolute beginner. And so the way actually we're going to calculate that, again, this is stuff you can definitely look up with a financial website on your own. However, we're going strictly from a 10K viewpoint. Like we said, sometimes it could be wrong. And it's also good to just know how to do this in general. It's kind of like, I don't know, learning to do something old school, even though there's new technology that can help you do it new school. Of course, I can't really think of a good example like that right now. But I'm sure one popped up in your head and you know what I'm talking about. So everything here, so shares outstanding, we're definitely going to get this from the annual report. And so what we want is the diluted number of shares outstanding, and that's right here. So this is how I can't remember if any during parts 1, 2, or 3 if I did this to show you how to find shares outstanding. There's one way to do it if it's not showing up in the income statement. Again, Control F is a very valuable tool when you're looking through an annual report. The share price, that one, at least we know the financial websites probably can't mess up, right? I mean, you would hope. So we'll do it that way. And so the way to calculate market capitalization is you just take your share price and you multiply it by the shares outstanding. That will give you your market cap. So, the 250 billion mark. Of course, theirs is different also for FinViz. And I wonder if that's because they're using basic instead of diluted. So let's look at that. I like diluted. I've talked about that in the past. No. I don't know what their deal is. Maybe, it could be that there's extra shares where they're like, it's like a rounding thing, right? Where there's a decimal point and there's actually more numbers of shares here. But I doubt it. If we double check what their share price is, 83.38, right? They're showing 247.28. They're showing. Okay, see. Oh, there you go. Well, theirs is different than Finviz's, which is showing 242, which is different than if we called this one like basic, right? And we call this one all right. So diluted says it's 250 billion. Basic says 249 billion. Finviz says 242 billion. And Google Finance says 247 billion. So there you go. Not a single one had the same. So that's going to throw off calculations a little bit. But, if you're doing everything sourcing from the 10K, then that's good because at least you'll be consistent throughout, right? So if I'm using my calculations for debt to equity, I'm using my calculations for market cap, I'm using my calculations for shareholders equity, that I sourced, that I saw, that's in the 10K. This is, consolidated. It's been pushed through the auditors, so I know that it's correct information. Then I'm confident that, well, at least my interpretation of it is going to be sound, and I can understand why. I can double check why, and theirs might be different. But if I'm okay with how I am kind of making the justification, then I'm going to feel confident with it. So, for example, I'd rather take a worst case scenario, and I would rather have a diluted version where, the difference between basic and diluted is kind of the same concept of accrued liabilities, in the sense that it's taken into account as if every person, stockholder, employee in the business who owned like stock options in the company as an employee, where if they were to exercise all of their stock options at the same time, then that would be the diluted common shares outstanding. So I always like to be pessimistic and take the worst case scenario, just so that it's like a more conservative calculation. Because in like a price to book calculation, the higher the market cap, the worse it's going to be for our calculation purposes. So that's going to be something to just keep in mind. So because I know that I'm happy being conservative like that, then I can know that my price to book calculation, even though it might be off by a couple not decimal points, but a couple tenths, right? Where it, I'm still going to get something around 3.1, but it won't be, it's not like it's going to show a 5 when they show a 3, right? But it might be just a little diminutive difference. And as long as I'm okay and I understand why mine's different, and I understand that mine will be different because I'm calculating it more conservatively, then I'm okay with that and I can move forward. So to take something like the price to book, you would take the market cap and you would divide it by the book value or the shareholders equity. And like I said, it's going to give us something close. So we're still at like 3.1. So close enough. 0.06 difference. So anyway, that's how you use the balance sheet. That's how you try to navigate it when you're using an annual report, and try to create some, try to create some things, like some calculations, some ways that you can look at the data and have it mean something to you and have it tell you what's going on in the business. So I use this as an example. The debt to equity rose from here to here, so that might be a bad sign. If it goes from like a 0.2 to a 1.5, that's a really bad sign, because then it just exploded up. It can tell us a general overall picture of the debt to equity by saying, hey, well, this one, is around 1.5. The average is 1, so it's a little bit higher leverage company than the average. So it tells us that picture, and then it also tells us how expensive it is in the market compared to how many assets you're getting. I believe the average PB, price to book ratio, let's find out because I can't remember. But it's around there. So, like the average price earnings ratio is around 17 throughout the years. So, yeah, looking at like a mean of 2.77. So, at the 3.11, Walmart's higher than the historical mean. We're looking at from 2000 2008, right? And compared to the current S&P, it is lower. Of course, when it comes to price to book, you want to look at things like industry and same with debt to equity, but it's your discretion how much or how little you want to put into using industry comparisons for making investing decisions like that. So I'm going to pretty much wrap it up right there. Hopefully that was helpful. Hopefully now you know how to look at a balance sheet better and make some observations from it. Definitely I would like to hear from the audience what your opinion is with kind of what we stumble across today, right? Let me know if you prefer using like a price to book, for example, that you calculated from the 10K yourself. You feel more comfortable using like a Google Finance one or using like a FinViz one, right? And maybe you can talk about if you've ever run across this or not, and we can have a little bit of a discussion in the comments, and maybe that can help give us insight as the tutorials go on for how this is affecting other investors. I know for a fact when I'm doing like value trap indicator stuff, my price to book, price to sales, price to earnings, all those types of calculations are basically almost guaranteed to be different from like what's on FinViz. But at the same time, big examples, if a 10Q is coming up, right? A lot of these financial websites, they will update these numbers based on their 10Q, on the latest 10Q. And so that's going to skew everything. And since I'm always sourcing the latest 10K, well, if there's a previous 10Q since the last 10K was announced, then of course mine's going to be all different. I'm assuming the difference here has to do with the fact that they're not sourcing a 10Q but something more immediate. And I'm sure I could get down to the bottom of it if I really wanted to, or if you really wanted to. But I feel like it's just kind of splitting hairs at this point. But anyway, that's kind of the whole thing. So I'm definitely going to have another tutorial video next week. That's going to be on the cash flow statement. So instead, I know in the beginning I said we're going to look at price to cash, but we'll do that next week. We looked at price to book, we looked at debt to equity, we looked at the balance sheet, and we'll have one more at the end too for part 6. So make sure you're subscribed to the YouTube channel if you want to get notified when that next video goes live. It's going to be on a Saturday as well. So hit that big red subscribe button. Also, feel free to check out, like I said, I'm going to put this spreadsheet up on a folder on a Google Drive. And that's where I'll, obviously I do a lot of spreadsheets when I make these YouTube videos. So I'll start to make like a master folder where people can go back and reference them, edit them, do whatever they want with them, right? So I think it would be a bit useful. So, if you want access to that, make sure you're subscribed to the email list. I'll send an email out, but also, every time somebody subscribes to the email list, I'll put a link in there so they can access these spreadsheets. But if you're not subscribed to that email list, that's stockmarketpdf.com, and you'll get the 7 steps to understanding the stock market ebook for free when you subscribe, and you also get daily tips with a lot of different stuff covered. And then also you can check out the playlist on the channel. Obviously I made the playlist for the 10K tutorial series. There's also one for how to analyze a stock with valuations, which can be very, very helpful and gets down into the price to book stuff, more nitty gritty, price to earnings, and even the value trap indicator. So that's going to do it for me today. Stop working for money, put money to work for you. I will talk to you next time. Peace.